Hi, Trip here. I'm continuing the Investing 101 series. In part 2, I discuss stocks. In part 3, I'll be discussing dividends. One of my favorite parts about investing is dividends and the passive income that it can gain for you when you choose to invest in stocks. If you're already familiar with investing in real estate, you might be looking for multiple forms of income from real estate. One form might be home price appreciation, and stocks, you'd be looking for share price appreciation. Another form of income from real estate investing is receiving rent. Well, dividends is a lot like rent. It's continuous payments that owning the business pays you. And in my prior webinar, I covered JP Morgan Chase, and we were looking at it, and it has a dividend yield of 2.23%. That's not too bad, but I wanted to show you how you can dig a little deeper into those dividends. So there's an interactive chart on Yahoo Finance, and once we click that, we can learn a little bit more about the dividend history of this stock. So we can see it recently paid a dividend on January 4th of 48 cents. If we go back a quarter, there's another 48-cent dividend, another 48-cent dividend. Back here on April 4th, 2016, a 44-cent dividend. So there was a dividend increase from 44 to 48 cents. If we go back further, 44 cents, 44 cents, 44 cents again, and back on April 1st, 2015, a 40-cent dividend. So that's a pretty nice dividend growth rate there. It jumped by about 10% in 2015, and then 9% or so in 2016. Very, very encouraging sign to see. But when I'm evaluating a stock, I'm not concerned about just the last 2 years of dividends. I want to know much longer history. So let's look back, say, 10 years. Okay, so we're seeing further back in 2013, it was a 30-cent dividend. 2011, a 25-cent. 2010, a 5-cent dividend. So there was a huge jump there. 2009, a 5-cent dividend. 2008, a 38-cent dividend. So this was prior to the financial crisis. You could see there was a large dividend of 38 cents, and then it suddenly dropped to 5 cents. And it took it several years to get back to that 38-cent level until 2013. I wish I could say it was all rainbows and butterflies when it comes to dividends, but sometimes you can get really burned if you assume that the dividend that you're receiving, you're just going to continue receiving forever. Let me show you another example. Another stock that people who looked at JP Morgan Chase look at often is Bank of America. And let's see, it has a little more rugged dividend history. Let's look at its 10-year interactive chart. It had a dividend of 64 cents in 2007, and then it dropped to a 1-cent dividend in 2009, and stayed that way until 2012, even into 2013. Finally, in 2014, it got increased to 5 cents, and then in 2016, 7.5 cents. It's still nowhere near that 64-cent level. So you really want to analyze, is that dividend safe? And I referred to this payout ratio of 60%. You want it to be at 60% or below of the company's earnings are being paid out in dividends. But more than that, is the company's money-making capacity safe? And Unfortunately, a lot of these financial stocks prior to the financial crisis, they were investing in mortgage-backed securities, and the rating agencies were lying about the quality of those assets. And so that's a big source of where these dividends were coming from, and then they had to be suddenly cut. Not all companies pay their dividends quarterly. A lot of non-US companies might pay them twice a year. So this is one of the foreign companies I was referring to. It's called Diego, and they pay their dividends twice a year. Here's a dividend payment in August. Here's another one in February, another one in August, and another one in February. And if you look real close, you'll see that the August dividend payment is much higher. It's $2.18 versus the February one at $1.30. So just something to be aware of. U.S. companies tend to be pretty consistent in paying their dividend quarterly, at least most U.S. companies. But foreign companies, they might have a different dividend payment schedule. Additionally, the foreign government will go ahead and withhold dividend taxes from the dividend payment by the time you even receive it. So there's a way on your U.S. tax filing that you can exclude the taxes you've already paid on your foreign dividends so that you don't have to pay taxes again on the dividend money you've received from foreign companies. This is a bond fund. A lot of bond funds tend to pay their dividends every month. So if we look at its dividend history, we can see there's a dividend paid in December, and another one in early December, one at the beginning of November, beginning of October. For some reason, September got skipped, then beginning of August, beginning of July. Basically, bond funds, they'll pay interest payments, and they tend to pay them once per month, whereas a stock or a stock fund might pay their dividends quarterly. This is an emerging markets index fund, which means non-US stocks, typically in developing economies like China, India, Brazil, Russia, Mexico, those types of countries. And these types of funds, they pay their dividends quarterly, but the dividend amount will vary. Here's a 17-cent dividend payment, a 45-cent dividend payment, 22 cents, and 6 cents. So it really matters when you buy into the fund, which dividend payment will be the next one that you catch. It'd be nice if when you're investing the price is low and you can catch it right before the big dividend payment that happens in the third quarter, as opposed to right before the big dividend payment, the small dividend payment that happens in the first quarter. And it tends to have this trend from year to year. So this is how you look at dividend history. I encourage you to look way back, go 10 years back or further. Find companies that pay their dividends every year, even in down economies, and preferably even grow their dividends during recessions and in down economies. Some of the most successful U.S. Companies have managed to pay their dividends or even increase their dividends for a span of 40 or 50 years continuously. Well, that's pretty much all I have to say on dividends. Thank you so much for tuning in. Please subscribe and catch the next series of Investing 101. This was Tripp at Financially Possible.